So something you hear a lot about that many people don't understand are tax abatements and TIF, and people want to know what that is. You hear counties and cities doing this a lot, so I'm happy to explain both of them. There are two basic ways that local governments can direct incentives to encourage development or investment in an area. Both of them can be controversial because they're either A, allowing a private entity to not pay a portion of their property taxes, or B, giving tax dollars away directly to private entities. I'll start with the first one, which is tax abatements. A tax abatement is where a local government will tell an entity that they do not have to pay a certain amount of property taxes if they do certain things. Let's call them improvements. Now, these improvements could be renovating a building, building a new building, or even just adding capital equipment. The idea being that whatever it is they're doing is going to be good for the area and perhaps even increase jobs. Now remember, property taxes are based on assessed value. So when improvements lead to an increase in value, those taxing units are going to collect more revenue. So as an incentive, the local government will say, well, you don't have to pay a certain amount of those increased taxes for a period of time if you make those improvements. Those taxes will be abated. Now the local government will work with the business to determine exactly how much they don't have to pay. I've seen 25%, 50%, I've even seen 50%. Here's an example that we're going to walk through. Say we have a property with an assessed value of $50,000 and they are paying $500 in taxes. So say this local business then approaches the local government and says, hey, I'm willing to invest and add a second building here that's going to add 10 more jobs to this area. In exchange, I would like you to give me a 50% property tax abatement. So now without that abatement, their total property value would now be $100,000, which means they would now be paying $1,000 in taxes. With the abatement, they will still pay the original $500, but they're only going to pay 50% of what the increased value is. So instead of paying $500 additional, they cut that in half. They're now only paying $250. Now their total tax bill is $750 instead of the $1,000 because of the tax abatement. So there's a lot of rules and regulations that the state provides that governs this, but the local governments can also set their own policies and guidelines. Also, the local government has the ability to inspect to ensure that this business actually upheld its portion of the bargain during the application process. Did they actually create the 10 jobs that they said they were going to or not? Are these follow-ups happening? Issues around transparency and accountability around property tax abatements. These are all really good questions that come up a lot and great topics for discussion between residents and local officials.